Welcome back to the quarterly call. All content is for informational purposes and is not investment advice. Please consult with an investment professional. All right, we're jumping right into the latest update from the absolute cutting edge of chip manufacturing. We've got the Q3 performance details, yes, but maybe more importantly, some really significant strategic announcements.
That's right. I mean, you look at the Q3 numbers, and they're solid, definitely confirming a successful period.
Yeah, no doubt.
But the real meat here, the thing you really want to understand, is this glimpse into their multi-year capacity planning. It's like watching a high-wire act, isn't it?
How so?
Well, the engineering, the financial maneuvering needed to actually support this massive AI boom we're seeing globally. It's unprecedented.
Okay, so that's our mission today then. Extracting those key insights, especially where this, super advanced manufacturing capability meets the absolute explosion in AI demand. We're talking huge capital spending, pushing forward next-gen stuff like N2 and A16 faster, and this whole complex puzzle of building factories all over the world. Not just single fabs anymore, but these huge clusters.
And that right there, that's the core tension, isn't it? It's laid bare in what we've heard. How does a foundry, a business built on incredible discipline, on years-long planning cycles, suddenly hit the accelerator?
Especially for AI.
Especially for AI, which seems to grow exponentially. How do you do that while managing the costs, the dilution from new tech ramps, building overseas? It's a fascinating strategic balancing act. We're really looking at their playbook for managing speed and discipline.
Okay, let's ground ourselves first. The Q3 2025 numbers, they did beat expectations, which sets a pretty stable stage. Revenue hit $33.1 billion. That's a jump of about 10.1% from the previous quarter in U.S. dollar terms, so definite acceleration there.
And it's not just the top line. The margin story is, well, really good, too. Gross margin climbed sequentially by 90 basis points, hitting 59.5%.
Almost 60%. That's huge.
It is. And keeping margins like that while you're scaling and investing billions, that's the hard part. They even pushed operating margin up over 50% to 50.6%.
So that 59.5% gross margin, let's dig into that a bit. It wasn't just selling more stuff, right? Volume helps. But the update pointed to specific internal drivers.
Exactly right. The main engines were, 1, successful cost improvements they've been working on, and 2, just running their existing fabs at a higher utilization rate.
Tuning the machine, basically.
Pretty much. Getting everything running as efficiently as possible. And these internal gains were strong enough to actually fight off 2 pretty big headwinds at the same time.
Okay, what were those headwinds?
First, the financial hit from ramping up the new overseas fabs. We'll definitely talk more about those later.
Right.
And second, they got dinged early in the quarter by unfavorable foreign exchange rates. So the fact that margins still went up sequentially tells you just how effective their internal cost controls are. They're constantly finding ways to squeeze more efficiency out.
And the bottom line. Earnings per share came in at TWD 17.44. Now, we try not to get lost in quarterly figures, but seeing that jump 39% year over year, that's a strong signal.
It is. It shows their pricing power, the value of that advanced node mix. It's all working as planned.
Yeah.
And underpinning all of this is a very healthy return on equity, sitting at 37.8%. For you listening, that high ROE, it signaled real financial strength, efficiency in using capital.
And that strength gives them the room to maneuver, right?
Yeah.
To commit to these eye-watering CapEx numbers for the AI push.
Precisely. That foundation is what lets them make these huge global bets.
Okay, let's pivot to the Q4 2025 guidance. What are they expecting for the immediate future?
So revenue guidance is actually for a slight sequential dip. The range is $32.2 billion to $33.4 billion.
A plateau.
Sequentially, maybe a slight dip at the midpoint. But and this is key. Look year over year. That midpoint is still up a massive 22%. So the underlying long-term trend is still very strong.
Right. Context matters.
And here's the interesting part. Even with that potential slight revenue dip quarter on quarter, they're guiding for higher gross margin in Q4. The target is between 59% and 61%. Midpoint hits 60%.
Okay, wait. How does margin go up if revenue might dip slightly?
Well, this is mostly down to a more favorable foreign exchange rate assumption for Q4. They're planning around a rate of roughly USD1 to TWD 30.6.
So a currency tailwind.
Exactly. And that FX tailwind is expected to be strong enough to basically cancel out the continued margin drag from ramping those overseas fabs.
I see.
So they're kind of using the predicted currency movements to help smooth out the margin profile while they're absorbing all these internal expansion costs.
That's pretty sophisticated financial footwork. It lets them keep those profitability numbers looking good even while they're pouring billions into building stuff everywhere, using temporary boosts to cover the unavoidable costs of growth.
It speaks to the strength of the core business, doesn't it?
Definitely. Now, let's unpack what is driving that revenue. The technology mix in Q3, it's just dominated by the leading edge.
Completely. 3 nanometer, N3, that was 23% away for revenue.
Yeah.
5 nanometer, N5 was the biggest chunk at 37%.
Still the workhorse.
Pretty much.
Right.
And then you add in 7 nanometer, N7, which is still quite advanced at 14%. You add those up.
74%?
74% of all their wafer revenue came from these advanced nodes, 7 nanometer and below.
Yeah.
That's their competitive advantage right there in numbers.
And that heavy lean on N3 and N5, it's just so critical. I mean, how fast would things unravel if a competitor actually caught up on yield and volume there, based on the value implied in the update?
Oh, it'd be immediate and severe. This tech lead isn't just having the tech node, right? It's the yield, it's the scale, it's getting it to market reliably quickly.
Yeah.
N3 and N5, right now, they represent this almost insurmountable barrier for competitors at scale. It allows them to command that price premium, the ASP increase, because they're the only ones who can reliably make these complex chips in the volumes needed, especially for AI and the top-tier smartphones.
And pushing N3 variants out quickly lets them keep that overall margin target near 60%, even with N2 starting to dilute things soon.
Exactly. It's a constant balancing act.
Okay, let's look at the platforms. Where's the demand coming from? HPC, high-performance computing, that includes AI. It's flat quarter on quarter, but still the giant 57% of Q3 revenue.
Still the engine, yeah. But while HPC holds steady as the anchor, the really encouraging sign was in the more cyclical markets, the non-AI bits.
Right. What happened there?
Smartphone revenue bounced back nicely, up 19% sequentially. Now it's 30% of revenue.
Okay, that's significant.
IoT jumped 20%, though it's smaller at 5%. And even automotive, which can be up and down with inventory, that climbed a very healthy 18%, also hitting 5%.
The only one down was DCE, digital consumer electronics. That fell 20%, but it's tiny now, only 1% of revenue.
Yeah, pretty negligible. Yeah. But that clear uptick in smartphone, IoT, and auto, that's a really important signal. It backs up their comment that these non-AI segments seem to have finally bottomed out and are seeing a mild recovery.
Okay, so it's like two engines firing now. You've got the structural kind of explosive growth from AI and HPC.
Right.
And then you've got this gentle cyclical recovery picking up volume in consumer and auto markets.
That's it, exactly. The basic demand for phones, cars, gadgets seems to be stabilizing, maybe even growing a bit. And that sets the stage for more volume next year, volume that probably uses slightly older but still very profitable nodes.
So it adds a layer of stability alongside the massive but maybe more volatile AI demand?
Precisely. It gives them a bit more predictability.
All right, let's really dive into the main event. AI. The language they used around this demand was, well, pretty enthusiastic.
Yeah, very strong was the baseline, but then they added it was significantly stronger than they had anticipated just 3 months ago. That's quite a statement.
It tells you something's changing rapidly.
It really does. And that increased confidence feeds directly into an updated forecast. Remember, they were projecting AI accelerator revenue growth, the CAGR, between 2024 and 2029 in the mid-40s%.
Which was already incredibly high.
Already huge. Now, they're saying they expect it to be a little bit better than that.
Okay.
They're essentially signaling that the growth curve is even steeper than they thought just 1 quarter ago.
Wow. And that structural strength lets them forecast, what, full year 2025 revenue growth close to mid-30s% year over year?
In US dollar terms, yeah. All driven by these leading-edge nodes.
So managing that kind of growth, that structural shift, it demands a whole new level of planning, doesn't it?
Oh, absolutely. The update stressed why their lead time for engaging with customers has stretched out. It's now 2 to 3 years in advance.
2 to 3 years? Why so long?
It's the sheer complexity of the process tech, yes, but it's also just the time it takes to get the key equipment in place. Think about those huge, complex EUV lithography machines. You can't just order those off the shelf.
Right. The supply chain for the tools themselves is constrained.
Exactly. And they also mentioned their forecasting approach is different now. It's not like the old PC or smartphone cycles. They're doing what they called a top-down demand assessment.
What does that mean in practice?
It means they're talking directly to their customers' customers, engaging with the big hyperscalers, the social media giants, the search companies.
Why?
To understand the actual real-world usage, the traffic growth, the demand profile building up in those massive data centers, it gives them a much deeper view of future demand than just taking orders from the chip designers themselves.
That deep visibility, it leads to this really interesting point that came up, the idea that Moore's law is dead, supposedly coming from a major customer. Now, how does a company build on Moore's law respond to that?
It sounds like a contradiction, doesn't it?
Yeah.
But their explanation was actually one of the most insightful parts of the whole update.
Okay.
They said, look, when a customer says that, it doesn't mean tech progress stops. It means focusing only on the front-end chip, the transistors getting smaller, isn't enough anymore. Not for the kind of performance jumps AI demands. The game has changed.
So if shrinking transistors isn't the whole story, where does the focus shift?
It shifts to system-level performance. This is the heart of their Foundry 2.0 idea. You have to optimize everything together. The chip design itself, yes, but also the back-end integration, the advanced packaging that connects everything.
So they're not just selling silicon wafers, they're selling a whole computational solution.
Pretty much, which means much deeper collaboration with customers on the entire design, soup to nuts.
Okay, that system-level view helps explain another puzzle, the token growth paradox an analyst raised. If AI progress means token consumption is growing exponentially, doubling every few months, say, why is the AI revenue CAGR only 45%? Seems like a mismatch.
It's a fantastic question. It forces you to think about the difference between physical chip volume and computational efficiency.
Ah.
And their answer is node migration. Moving customers from an older node like N5 to a newer, much more efficient node like N3 or soon N2, that migration delivers the exponential increase in token compute power, but does it efficiently.
Can you break down that efficiency gain a bit more?
Okay, think about it like this. An old computer server took up a whole room for a certain amount of processing power, right?
Sure.
Now, you move that same workload to a modern cloud server. The physical footprint shrinks dramatically, but the speed, the energy efficiency, they improve by like orders of magnitude.
Okay, so the new N3 or N2 chips, they're so much more powerful per square millimeter
Exactly.
that the customer doesn't need to literally double their wafer orders every year just to double their compute power.
Precisely. The exponential token demand is met by these leaps in technology and efficiency. So you need fewer physical wafers for the same unit of computation over time. The foundry makes money not just on volume, but by charging that higher price, that ASP premium, for the incredibly complex, efficient, superior new chip.
Which all comes back to why that technology leadership is just fundamental to their whole model.
It's everything.
Okay, but even with that efficiency gain, capacity right now is clearly stretched thin. They said explicitly both front-end wafer production and back-end packaging are very tight.
Yeah, no question. And the minute you talk bottlenecks, the conversation immediately goes to CoWoS, that advanced packaging.
Chip on wafer on substrate.
Right. It's absolutely critical for tying together all the different bits needed for modern AI accelerators, the logic chip, the memory, the high-speed connections.
What makes CoWoS so hard to scale up quickly? Is it just specialized tools?
It's that, but it's also the process itself. It's this complex, multi-step assembly. It needs extreme precision, unique tools that are specific to packaging, not the same as the front-end wafer fab tools.
Right.
So ramping CoWoS means getting a whole different set of specialized, expensive equipment, and the lead times for that equipment can be just as long, maybe longer, than the front-end EUV machines.
And they're working flat out to close that demand-supply gap through 2026, acknowledging that even their previous plans, like doubling capacity, might not have been enough given how fast AI is moving now.
Yeah, they basically admitted the goalposts keep moving.
No. Shifting gears slightly. Geopolitics. How much impact are things like U.S. export controls or China trying to push out U.S. chips having on this AI growth story? Could that derail the 40% plus CAGR?
They seemed pretty confident, actually. They basically said, look, the 40% plus CAGR is achievable. It's driven by the huge global market demand, mostly outside of China.
Okay.
Obviously, they're watching geopolitical risks, market uncertainty. But their main customers for GPUs and ASICs, they operate globally. So they're somewhat insulated from purely localized restrictions hitting one specific country.
Speaking of GPUs versus ASICs, these custom chips some hyperscalers are designing, is the company prioritizing one over the other?
No, they were very clear on that. They see demand from GPUs and ASICs as equal. Why? Because both types of chips use their absolute top-tier leading-edge nodes, N3, N2, and they both need that CoWoS packaging.
So from a foundry perspective.
From their perspective, it doesn't matter what the chip architecture is. If it needs the best tech and the most advanced packaging at scale, they'll support it. No differentiation was the phrase used.
Okay. One last thing on quantifying AI before we move on. There was this interesting attempt using data center power. Like 1 gigawatt of new data center investment equals maybe $50 billion. How much wafer revenue does that translate to?
Huh. Yeah, it was a clever try to find a common yardstick.
But
they couldn't really give a specific number. They highlighted the complexity. These modern AI systems aren't just single chips. They're these intricate multi-component systems glued together with advanced packaging.
right.
So the revenue comes from the value of that whole system, not just a simple wafer count. Makes it really hard to draw a straight line from gigawatts to wafer dollars.
Okay, so to actually build all this capacity needed for AI and everything else, we need to talk CapEx, capital expenditure. They tightened the 2025 guidance,
Yeah, narrowed the range to between $40 billion and $42 billion.
which is still an astronomical amount of money.
Absolutely. The fact they narrowed it shows confidence,
Yeah.
and nudging the bottom end up slightly from the old $38 billion lower bound.
Yeah.
That signals how strong they see this AI demand continuing.
And how are they allocating that 40+ billion?
The breakdown is revealing. About 70% goes straight to advanced process technologies. That's your N3, N2, A16 development and capacity.
Okay, kind of.
Then maybe 10 to 20% for specialty technologies, the slightly older nodes for auto, IoT, etc. And critically, another 10 to 20% is specifically earmarked for advanced packaging, testing, and mask making.
That confirms the CoWoS push.
Directly. They are throwing serious money at solving that packaging bottleneck.
And their underlying philosophy seems pretty clear.
Yeah, they stated it directly. A higher level of capital expenditures is always correlated with higher growth opportunities in the following years. Spend big now to reap bigger rewards later.
So that spending funds the roadmap. Let's look at those next-gen nodes getting accelerated. N2, 2 nanometer. What's the latest there?
N2 sounds like it's right on schedule. Volume production kicking off later this quarter, so Q4 2025. And they mentioned good yield performance already, which is key.
And the ramp-up.
They expect N2 to ramp faster in 2026 than previous nodes did. Why? Because it's being pulled by both HPC AI and the next big smartphone launches.
Yeah.
Dual engines driving demand.
And they're already planning beyond the initial N2.
Always. N2P is the follow-on, an extension offering better performance and power efficiency. That's slated for volume production in the second half of 2026. The pace just doesn't let up.
But the really interesting one maybe is A16. What's the big deal with A16 for AI?
A16 is where they introduce Superpower Rail, or SPR. This is a pretty fundamental change.
Okay, explain SPR. Why is it revolutionary?
Think about the physics of really big chips, like these massive AI accelerators. Delivering power evenly across that huge area is a major headache. The power lines themselves take up space on the chip surface, create resistance, waste energy.
Right, plumbing challenges on a tiny scale.
Exactly. Superpower Rail tackles this by moving the power delivery network to the back of the wafer. Yeah. Power comes in from underneath, essentially. This frees up enormous space on the front side, the active side, for more complex signal routing and packing transistors even more densely.
Which is exactly what you need for the biggest, most power-hungry chips.
Which are AI accelerators. Precisely. A16 with SPR is tailor-made for those huge HPC designs needing complex wiring and tons of power delivered efficiently. And that's also on track for volume production in the second half of 2026.
So this whole family, N2, N2P, A16, the goal is clear.
Create another large and long-lasting node, just like N7 and N5 have been huge successes. That sets them up for growth in 2026 and beyond, driven by, as I said, all the above, moving customers to N2, getting higher prices for that tech, and just general volume growth from that mild cyclical recovery.
Okay, let's talk about where they're building all this stuff. The global footprint expansion, it's a huge topic.
It is. And their message is consistent. Decisions are driven by customer needs, the desire for geographic options, necessary government support, and always maximizing shareholder value.
But the updates show a real acceleration, especially putting the most advanced tech overseas now, driven by AI. Let's start with Arizona.
Right, the U.S. side. Things are actually speeding up there. They're pulling in the technology roadmap faster than originally planned, upgrading quicker to N2 and even more advanced processes beyond that.
Why speed up?
Direct response to urgent AI demand from U.S. customers. They need leading-edge capacity stateside, and they need it sooner.
And the scale in Arizona sounds ambitious. They're talking about securing more land for an independent gigafab cluster.
Yeah, let's break down that term, gigafab cluster. What does independent imply there?
Good question.
It suggests more than just a wafer fab. It points towards a whole self-contained ecosystem. You'd have the advanced wafer manufacturing, yes, but also advanced packaging facilities, specialized testing, maybe even key suppliers co-located nearby.
A whole mini hub.
Exactly. For those big smartphone, AI, HPC customers, having everything in one place cuts down complexity, boosts resilience. It sounds like they see this cluster model as necessary to support these multi-year, billion-dollar AI roadmaps from their U.S. customers.
And related to that, they announced plans for two of their own advanced packaging fabs in Arizona, directly tackling that CoWoS need there.
Yes, long-term. But for the immediate packaging needs in the U.S., they're using partnerships.
Right, the OSAT collaboration. Remind us what OSAT is.
Outsourced semiconductor assembly and test. These are companies that specialize in the final steps, putting the chip in its package, testing it. Critical back-end work.
And this OSAT partner is starting construction even before the company's own packaging fabs get going. Why the rush?
It's a tactical bridge. It lets them offer made-in-the-U.S. advanced packaging solutions much, much sooner. They don't have to wait years for their own fabs to be built. It solves an immediate bottleneck for customers demanding U.S.-based final assembly for AI chips. Very pragmatic.
Okay, shifting focus. Japan, the Kumamoto specialty fab.
That one started volume production late last year, focusing on slightly less advanced nodes, and they reported good yields, which is positive.
And they're building a second one there.
Construction has started on Fab 2 in Japan. Again, the ramp timing depends on specific customer commitments. That Japan focus seems geared towards the strong local demand in automotive and industrial sectors.
And Europe, Dresden, Germany.
Similar story. Construction is underway for that specialty fab, progressing smoothly. Ramp schedule also tied directly to customer demand in the region.
But amid all this global building, they really stressed their commitment to Taiwan, didn't they?
Oh, absolutely. Very strong message there. Confirmed they're moving ahead with multiple phases of 2-nanometer production in Hsinchu and Kaohsiung science parks. Taiwan remains the core R&D and manufacturing engine, especially for the absolute leading edge in advanced packaging development.
Okay, managing all this ramping N3, bringing in N2, building overseas gigafabs. It must be a nightmare for managing gross margin. New tech always drags down the average at first.
It's a constant juggling act. Let's start with N3, the current top node in volume. The good news is the margin drag from N3 is gradually coming down.
So it's improving?
Yes. And the expectation now is N3 should reach parity with the overall corporate average margin sometime in 2026. It'll become a full contributor soon.
Just as N3 gets healthy, N2 starts its dilution cycle in 2026.
That's the treadmill of the leading edge. N2 will definitely dilute margins next year, just like any new node does when it first starts. But they did say the inherent structural profitability of N2 looks better than N3.
Better. Why? Is it the new gate-all-around transistor tech or just lessons learned from N3?
Probably a bit of both. New architectures can offer better power performance, making the chips more valuable relative to cost. Plus, they always learn a ton about yield and efficiency from the previous node ramp. So yes, N2 will dilute initially, but maybe not as deeply or for as long as N3 did.
They also made this interesting point that talking about how long a node takes to reach the corporate average margin is becoming less meaningful. Why downplay that metric?
Because the target itself keeps moving up. If N3 hits the average in 2026, that corporate average will likely be higher than the 60% they're targeting now, because the whole portfolio keeps getting richer with more valuable advanced nodes.
So it's a moving target that trends upwards.
Exactly. It reflects the increasing value capture across the board. Their overall structural profitability keeps strengthening, which is the bigger picture.
Okay, now the other big drag, the cost of building overseas. Arizona, Japan, Germany. How much are those pulling down the gross margin right now?
Actually, the near-term impact looks slightly better than expected. The dilution from overseas fabs for the second half of 2025 is now forecast closer to 2%. That's an improvement from the 2-3% they guided previously. Seems they're finding efficiencies quicker.
Okay, 2% dilution now. But what about the long term, over the next few years as these fabs fully ramp?
The expectation is for that dilution to be around 2% to 3% during the early ramp stages. But it could potentially widen to 3% to 4% later on, especially as more complex, costly processes like N2 get introduced in places like Arizona.
So it's a persistent cost factor they have to manage.
For sure. They're trying to mitigate it by scaling fast, aiming for that gigafab efficiency in Arizona, and constantly working to close the cost gap with Taiwan operations.
Lastly, before we wrap up, macro risks. AI demand seems bulletproof. Customer inventories are apparently healthy. But what external risk are they still watching closely for 2026?
The main one mentioned was potential disruption from global tariff policies. Specifically, tariffs hitting consumer goods or other price-sensitive market segments.
So not AI directly, but the other parts of the business.
Right. While high-end AI might be less affected, a big trade policy shock could hurt demand in those volume segments like IoT or standard smartphones, the very areas providing that stabilizing cyclical recovery we talked about. So they're keeping a wary eye on that.
Okay, let's pull this all together. It's a picture of a company going all in on the AI megatrend, right? Massively increasing CapEx, speeding up N2 and A16, battling the CoWoS bottleneck.
Absolutely. Full speed ahead on AI enablement.
But at the same time, juggling this incredibly complex global expansion, pushing the tech envelope in new places like Arizona, all while managing the inevitable margin pressures that come with such rapid change.
The real takeaway for me is this fundamental shift towards speed and integration. The AI opportunity is so big, it's basically broken the old planning models. Hence the 2 to 3 year lead times, the top-down forecasting.
And the Foundry 2.0 idea.
Exactly. Selling system-level solutions, not just wafers. That philosophy drives everything. The CapEx, the gigafab clusters, the deep customer partnerships.
And it feels like the pace is just getting faster, even compared to 3 months ago.
It really does. Which leads to maybe a final thought for you, the listener, to chew on. If AI demand keeps surprising to the upside, and the model is shifting to these huge independent gigafab clusters, how fast does that model need to evolve? Given the exponential token growth, the system complexity, those 2 to 3 year planning cycles, does that become the bottleneck? What does this relentless acceleration mean for supply chain stability and capacity needs in, say, 2027 and beyond? Is the gigafab concept already needing a rethink?
A lot to consider about the future pace. Really fascinating stuff. Thank you so much for tuning into the Quarterly Call. For more episodes, please remember to rate and follow our show. Until next time, stay curious and stay informed.